Hello everyone, welcome back. In this lesson, I'm going to talk about two very important topics that are closely related to each other: multiple arbitrage and margin management. I'll also share my personal views and some of my past experience so you can understand not only the how, but also the why behind these methods. Let's begin with multiple arbitrage. By now, I hope you already fully understand the basic routine of setting up a funding rate arbitrage position, and you know how to maintain the position by transferring USDT between two exchanges when necessary. Funding rate arbitrage is indeed a very stable passive income strategy. We don't need to predict price direction. We simply create a delta neutral structure and sit inside the volatility while collecting funding fees. As we discussed in earlier lessons, the chance of losing money is low and manageable as long as your stop loss, take profit, and margin settings are correct. However, sometimes you will experience a series of funding cycles where the net funding rate becomes zero. That means you earn nothing for that period. In that situation, you could close the position and open a more profitable one, but closing and reopening always comes with risks. You may experience slippage, pay extra trading fees, or fail to match the entry prices within a short range, which can break the delta neutral structure. For this reason, when I face a zero funding period, I usually prefer to sit and wait for the positive funding period to return. But of course, this creates a new problem. If you're holding only one arbitrage position and that position is earning zero funding for a few days, your overall return slows down. So how do we solve this issue? The answer is simple: set up multiple arbitrage positions. Instead of opening just one arbitrage pair, you can open 2 or 3 different arbitrage positions on different coins. This significantly increases the chance that at least one of your coins is generating positive funding in every funding cycle. Even if one coin earns zero, another coin may still be positive. This makes your daily income smoother, more stable, and more predictable. It is exactly the same idea as diversifying your traditional investments. If you rent out only one property, sometimes it might be vacant. But if you rent out 3 different properties, even if one is empty, the other 2 still bring cash flow. Multiple arbitrage works in a very similar way. At this point, some of you might think, why stop at 3? Why don't I open 10 arbitrages or even 100 arbitrages? The realistic answer is because maintaining many arbitrage positions becomes extremely difficult. Each arbitrage position requires daily monitoring. You must watch the unrealized profit and loss on both exchanges. You need to update your stop loss and take profit every time the liquidation price changes. You need to rebalance margin between exchanges. And you need to react quickly if the market suddenly becomes volatile. If you open too many arbitrage positions, you will eventually forget to update some of them. You will be mentally tired. You might forget to adjust a stop loss, or you may miss a margin update. And if just one position becomes unmanaged, it can be liquidated, breaking the entire strategy. For this reason, I personally limit myself to a maximum of 3 arbitrage positions at the same time. With 3 positions, I can maintain them well, adjust them properly, and keep everything under control without unnecessary stress. When you set up a funding rate arbitrage pair, you will always see a setting called margin mode. This setting is unique to crypto derivatives, and on almost every major exchange, such as Binance, Bybit, OKX, MEXC, and BitGet, you will find 2 options: cross margin and isolated margin. Understanding the difference between these 2 modes is extremely important for safe arbitrage trading. Let me explain how they work. In cross mode, all of your open positions inside the same margin account share one combined pool of collateral. This means if one position is losing money, the system will automatically pull margin from your other positions to keep it alive. At first, cross mode sounds attractive because it increases capital efficiency. You don't need to assign separate margin for each trade, and your unused balance can support any position that needs it. However, cross mode comes with two major problems. The first problem is that your liquidation price constantly changes. Because the margin is shared, the liquidation price depends on the profit and loss of all your other trades. This makes the liquidation level unpredictable. And for funding rate arbitrage, where we hold a long position and a short position at the same time, we need the liquidation price to remain stable so that we can manage our risk correctly. In cross mode, this becomes very difficult. The second problem is even more dangerous. If you are running several arbitrage pairs at the same time and one coin moves close to liquidation, that one losing position can drain the entire shared margin pool. And once it gets liquidated, your remaining positions may be liquidated as well, even if their prices did not move much. In other words, one bad pair can wipe out your entire account. This is a well-known risk in cross mode and is documented clearly by all major exchanges. Now let's talk about isolated mode. In isolated mode, every position has its own dedicated margin, and this margin is locked inside that specific trade. If one arbitrage pair starts losing money, only that pair is affected. Your other pairs remain untouched. The liquidation price for each pair stays fixed and predictable because the margin cannot move around. And even if one pair is liquidated, the rest of your account stays completely safe. For these reasons, I personally only use isolated mode when running arbitrage strategies. It gives me full control, stable liquidation prices, and most importantly, it prevents one position from dragging down the entire account. In arbitrage trading, especially funding rate arbitrage, stability and risk management are far more important than capital efficiency. And isolated mode gives us exactly that.